Go ahead and get started. Hello, everybody. Hi, Rod. Um,
Hi.
Welcome to the Great Disappearing Act, Decoding the Enigma of Instant Payment Fraud and Fighting Back Globally. We're here to unravel the complexities of real-time instant payments fraud, a challenge that is touching every corner of the globe and everybody in the payment chain. So I really appreciate you coming. It's a pleasure to see so many faces joining today in what we promise you will be an enlightening discussion. I'm Deb Baxley. I think most of you know me already. I'm a partner with Pagility Advisors and also on the board and co-founder of NiPay. And NiPay, we refounded in 2010. So we've been going for, I can't believe it, 13 years. And starting next year, we'll go back to some in-person events, but doing these virtual events has also been kind of a boon because we have people from all over the world. In fact, two of our panelists tonight are in the UK, Peter and Rebecca. So you'll forgive them because it's 11 o'clock at night there. And co-founding NiPay was one of the best things I ever did because I met all my business partners there, namely on this, everybody on this call probably knows David True and also Ron Mazursky and some of my other business partners. We all met through NiPay. I would like to thank our annual sponsors, Davis, Wright Tremaine, and Further Advisory. Their sponsors, especially since we've been doing virtual events and unable to charge anything, they have really helped us get through the past couple of years and maintain an ongoing presence through NiPay. So what the format of this is, you see it goes from 6 to 7:30 Eastern. So we'll spend the first 50 minutes or so with the panel, and we're going to delve into the cunning world of fraudsters, the roles of consumers, banks, regulators, what kind of tool education can be in this battle against fraudsters, about advancements of in technology and regulations. And then also one thing that's really important is the strength of collaboration against these threats, which is happening more or less. I see it's happening a lot more in the UK than it is in the US so far. So all of you, this is not like a normal webinar because you can all unmute yourselves and talk. But for during the panel, please keep yourselves on mute with your cameras off to just maintain our bandwidth and also to decrease distractions. For questions, you can actually unmute yourself anytime you want to and ask a question, or you can put a question into the chat. So we'll be monitoring the chat. As a matter of fact, David, I didn't ask you this ahead of time, but can you monitor the chat because I'm going to be
Absolutely.
doing that. Thank you. So we'll monitor the questions that might come up. And then when we're finished in an hour, we will go into networking. So we'll randomly break people into networking groups of 5 or 6 people. It's a nice chance to meet some of the other people, just the panelists. Although I have to say 2 of our panelists, as I said, are in the UK. I'm not sure if they're going to hang on the better end for that, but we'll see. So our panel today is composed of experts who've been on the forefront of the fight against fraud, and we're going to start with a presentation that talks about insights from around the world, including Nigeria, India, the UK, Brazil. And so I will quickly introduce our panelists and then go into some slides, and then we'll go into the panel discussion. So actually, most of us met through the Faster Payments Council. So Peter Tapling, who's with PTAP Advisory, I met him through the Faster Payments Council and also the Federal Reserve Faster Payments Task Force. Carla Sanchez Adams, who is an attorney with the National Consumer Law Center. We also met through the Faster Payments Council. And then Rebecca Moody, who's with a software company called Darwinium. I actually met her through the US Payments Forum. So we're big fans of joining industry groups, I guess. So there is a guy that we work with at the Faster Payments Council named Andrew Gomez, and he is located in Berlin. He works for Lippitz Advisors. So I'm going to share my screen. Hang on.
Basically steal a lot of Andrew's content, which is okay. He loves it.
Absolutely. So screen 2. There we go. Can you see it?
Yes.
Okay. Okay, so as I said, Peter, Carl, and incidentally, oh, I didn't mention Elspeth. Elspeth Bloodgood was supposed to be a panelist, and it ended up at the last minute she's on an airplane. So we also met her through the Faster Payments Council. She's with Jack Henry. And then Andrew Gomez from Lippis Advisors. And Lippis Advisors is a payments consultancy based in Berlin. And one of Andrew's roles is to manage their payments database, which covers 50 markets. So he's an expert on all things account to account transfers and faster payments with all different things going on around the world. And he looks at things like the size of the payments, the core infrastructure functionality, um, and so we're sharing some of his research as a level set for tonight's discussion. So the flags across the top are Brazil, Colombia, Japan, Mexico, Nigeria, UK, and obviously US. And what we find with faster payments, I mean, there's always been what we call non-authorized fraud, which is kind of like mostly account takeover. And that occurs in every market. But what's kind of new with the advent of faster payments is what's called APP, authorized push payment fraud. And in the past, some might not have even considered this fraud because it's mostly scams and trickery. So you get tricked into sending money through some kind of scam. And the Faster Payments Council, I mentioned, we did a survey in 2021 of US providers of faster payments. And we found that, well, synthetic identity, which is more of the non-authorized fraud, APP, authorized push payments, were the major new vectors for real-time payments. And what's interesting here is what, well, Andrew noted here that UK and Japan are the only ones so far really have regulations in place to protect victims of APP fraud. And that's one of the things we're struggling with at the FPC. And Carla and Peter and I and David True also, we're all in the fraud work group. We're talking about what regulation gaps there are in the US right now. Right now, real-time payments in the US are covered under what's called Reg E. You may have heard that term before. And what that implies is that businesses and consumers, not the banks, are liable for APP fraud losses. So if somebody tricks you into sending money, and it turns out it was a fraudster, the bank is not liable to replace your money, which of course consumers have been trained over the years that when they're using credit cards, the bank covers them. Well, that's not the case. So you can also see here that the US is kind of following what the rest of the world in terms of what kind of scams and fraud vectors we're seeing. So again, what we're interested in is investigating what mitigation measures have worked in other countries. And Andrew categorized these in two main types, the top tech-based approach and the bottom, which is a rules-based approach. You can easily see by just looking across here that most markets are doing a lot more than the US. What we've done in the US is mostly what I would call brute force method. So transaction limits, transaction holds, and awareness campaigns, education awareness campaigns. We're seeing a few more. That's what's really pervasive when you look at the number of check marks across these rows is centralized fraud monitoring. So we have here fraud monitoring system, a shared database of fraud information. Down on the bottom half here, we have a regulatory sandbox, security standards for QR codes and data. Then there's a few other promising techniques, which is confirmation of payee and dispute and loss recovery. So confirmation of payee is this one of the very first one. If you can confirm who the payee is, it might prevent you from sending money to a scammer. And then dispute and loss recovery here, that is, how if there is a fraud, how is that resolved? So of particular interest to us in the US are examples of industry collaborations, which they categorized into sending institution, the central payment system, and the receiving institution. So as I mentioned, the confirmation of payee is being done in Japan, Nigeria, and the UK to detect imposters, but also it helps prevent errors. And fraud monitoring systems in Brazil, India, Nigeria, and the UK, including scoring based on shared historical data. And then database management or data sharing in the Brazil, India, Japan, Mexico, Nigeria, and the UK, which shares data across the entire industry. The way of, helping the entire industry. So the FPC again is tackling this, and we have barriers to data sharing, including the fear of antitrust, the fear of lawsuits or reputational risk, privacy concerns, and competitive concerns. So those are some of the things that we are thinking about. So with that, I will move on to the panels. If you would please, each starting with Peter, introduce yourself briefly and give your point of view on the most significant and recent shifts in instant payment trends that consumers and businesses should be aware of.
Yeah, hello all. Great to join you from the UK. It's late in the evening here. I may have had a pint, so forgive me. I'm going to speak more freely than I normally do. PTAP Advisory. I'm an independent consultant. I've been in the kind of payments industry for 20 plus years, mostly from the fraud and identity space. I founded Authentify. They're the company that invented out-of-band authentication as you know it. So you can blame me when you get those annoying 6-digit pins to support a login. That company was sold to Early Warning. I was the chief revenue officer of Early Warning during the launch of Zelle, and have been doing advising to financial institutions and fintechs to help them understand each other in this world of identity and payments.
Great.
And I guess I should say along the way, I've been on the Faster Payments Council, steering member of the Secure Payments Council, board member of the, let's back up, on the Faster Payments Task Force, steering committee member of the Secure Payments Task Force, board member of the U.S. Faster Payments Council, chaired a couple of groups on the U.S. Faster Payments Council. Basically, I'm a glutton for payments punishment.
Yeah, join the club. Okay. So Carla, same question to you. Introduce yourself and give your point of view.
Hi, good evening, everyone. Carla Sanchez-Adams. I'm a senior attorney with the National Consumer Law Center. We are a advocacy organization, and we represent low-income consumers. I am board certified in consumer commercial law, and so basically I'm a consumer protection attorney, and I represented low-income consumers in litigation against banks, credit reporting, reporters, debt collectors, and for about 13 years before switching to this new role that I've been in for about 2 years. And, all things payments. So, I'm in charge of banking and payments and fintech portfolio, as well as debt collection and credit reporting at NCLC. And, as far as your question of the most significant and recent shifts for instant payment fraud, I think they're just ongoing and continuing. I continually hear from consumers as well as other advocates and lawyers about just the explosion of faster payment fraud after the pandemic, and it doesn't seem to be slowing, right? Like that, just the move from traditional banking and cash and card to faster payments has really exploded. And just, I think that you all already know this, it's nothing new, but just there is so much misunderstanding about consumer rights in this space. And, what happens when something goes wrong and consumers don't really know who do they talk to? Do they talk to their bank? Do they talk to Zelle, Venmo, PayPal, and all of the different players in this space? And when problems arise, who do they talk to? So, yeah, I don't think that's anything new to anyone. I would just say that is what I'm continually hearing about.
Great. And finally, Rebecca.
Thank you. Nice to meet you all. My name's Rebecca Meady. I run marketing and go-to-market strategy for a tech company called Darwinium. Darwinium does digital security and fraud prevention. I've been working in fraud prevention for the last 10 years or so. I have a special interest in scams and APP fraud. So across my career, I've sort of tracked the development of scams and APP fraud with the advent of the faster payment rails in the UK in 2008. And I have worked closely with a number of banks, with regulatory bodies, with the FCA, with Which, a consumer body, and with a consumer body called Stop Scams UK, to kind of collaborate industry-wide on better mitigation strategies to stop APP fraud and scams. And I guess the reason that I find it particularly interesting is, 10 years ago, we were looking at implementing fraud solutions that detected brute force attacks and, to your point earlier, unauthorized kind of access into customer accounts. And I think what financial institutions have got very good at is detecting unusual behavior at account login or at new account creation. But the challenge with faster payments is it's seen this huge rise in authorized fraud. And obviously that fraud is fully authenticated by the legitimate user of the account. And so suddenly your fraud mitigation strategies move from, strong authentication to actually being able to understand changes in user behavior, which might be indicative of a social engineering attempt or a coercion. And so at Darwinium, we've been working really closely with our customers, with the industry, with our prospects to build a solution that can better identify instances where there is unusual behavior across a payment journey. And yeah, we've been working with industry to kind of improve that situation. So yeah, always really interested to track kind of evolving fraud trends. And hopefully today I can give you a bit more context from the UK market, having kind of worked in it for the last sort of 10 years or so.
Great. Thank you, everybody. So Peter, let's start with you. What do you think is the biggest misconception consumers have about instant payments and their associated risks?
We have a challenge, particularly in the United States, that we have grown 2 generations of consumers who believe it's not their fault. Through the combination of Reg E and zero liability on card, the presumption is that I can do whatever I want. And if I don't like what happened in a transaction, I can call my bank and they have to give me the money back. Now, I am fully supportive of Reg E and unauthorized fraud, responsibility on the financial institutions and the payment systems. The challenge we have with authorized push payments is that word authorized. The customer said, go ahead and send my money to this person. And the analogy I give, and this is going to be intentionally way out there on the other end of the spectrum, but imagine that I want to go to a baseball game in the United States. I don't have a ticket, so I walk to the ATM. I pull $100 out of a Fifth Third Bank ATM. I walk up to a guy next to the stadium who says he can give me a box seat on the second row for $100. I give him the $100. I walk up to the stadium door and they scan the ticket and they say, hey, it's no good. So rather than walking around the stadium, because I'm a very macho guy, and finding the person who sold me the ticket and beating him up and getting my $100 back, I pick up the phone and I call a bank and I say, hey, I had $100 stolen from me. I want my money back. Now, all of us on the phone would listen to that story and say, well, wait a minute, that was cash. You knew exactly what you were doing and you lost it. And I'm sorry, it was a bad bargain, but you're responsible. And somehow in the E world, we tend to put all of the onus of this on air quotes faster payments, but faster payments is just a faster exit ramp that the bad guys have chosen. Scams have been around forever. Anybody who has worked at a financial institution and has done a ride along in the call center has heard the wire transfer story of Aunt May, who wants to send $10,000 to her boyfriend in the Philippines because he's going to come to the US and they're going to get married and live happily ever after. And we have this opportunity in Wire to talk to Aunt May and try and talk her out of it. The change in instant payments is we can't slow people down. When they hit the button, the money's gone. And so we do have to figure out as an industry, what's this balance between, and Carla's probably chomping at the bit to jump all over me here, but what's this balance between personal responsibility? You said you wanted the white puppy for $1,000 and you sent somebody $1,000. If you didn't get the white puppy, that's on you, versus payment system safety. Now, payment system safety is on the banks, it's on the financial system to make sure that consumers feel as though the way that they're making payments is safe. And I don't have an answer for that, by the way, but I think that you asked me the question, what's the pressing issue? I think the pressing issue is the balance between this idea of personal responsibility for the authorizer of a payment and what's the responsibility of the payment system.
Exactly. Well, and I guess the difference between the excellent analogy of withdrawing money from an ATM is that that kind of attack isn't scalable, and now this really is scalable. So, Rebecca, as I
scalability is good for the bad guys. You know, just
know.
like every other startup in the universe, they want to be $1 billion tech success.
Yep. So, as you all have noticed, I'm a big fan of joining industry groups. So I heard Rebecca speak at a U.S. Payments Forum member meeting a few months ago, and she had some really entertaining, or maybe we'd call them Halloween horror stories about scams. So can you talk about something that was particularly interesting or concerning?
Yeah, it's a good question. And actually, I can kind of pull in some of the points that Peter just made in his opening remarks there. So I will tell you a true story. Actually, Therese, this probably answers some of your questions you just put in the chat about concrete examples of user authorized fraud. So I will give you a short story of this is a true story. It's a close family friend of mine who fell victim to a pig butchering scam last year. Pig butchering scams tend to be where the fraudster kind of escalates the amount of money that they are asking from someone with promises of greater gains, generally for an investment, before kind of tapping out and asking for the maximum amount of money. So this family friend is a 76-year-old man. He is in a particularly difficult personal circumstance. His daughter's terminally ill with cancer, and he was looking for a way to support her to give up work. So, you know, typically fraudsters tend to prey on elderly and vulnerable people or people in a difficult life situation, and they tend to be more likely to respond to these types of scams. He saw an advert, we think, on a social media platform that promised good returns from a crypto investment that he responded to. And then the fraudster had basically set up a very convincing investment company. They had a full KYC check, got him to send pictures of his passport, got him to verify his address. They had a registered address, a full website that was a dummy site of an FCA registered company. They created an account for him with a dummy showing his dummy investment growing. And in the background, they got him to install a remote access software, which gave them access to all of his keystrokes. They knew how he was logging into his bank account. They also helped him set up a Kraken account, a cryptocurrency account in the background, which they put as their ruse for the investment fund. And then over a period of 3.5 months, they convinced him to transfer £100,000 in £10,000 payments into this Kraken account, showing his investment growing in the dummy site while they withdrew his money in Bitcoin from the cryptocurrency. Now, Peter, I guess this is a really good challenge to your opening statement of this is a vulnerable customer who has been really, really well socially engineered to totally believe in the investment he's making. He had done research online. He, as an FCA, cloned site, and that was a very, very sophisticated scam. And I guess the challenge to his bank is, where do you pick up the warning signs that something is amiss? Could they have picked up the remote access presence on his machine that wasn't there previously? Absolutely. Could they have picked up the fact that him as a 76-year-old man making new payments to a cryptocurrency platform was unusual? Absolutely. Could they have profiled the typical payment transactions across his lifetime of payments and noticed that £100,000 in 3 months was unusual? Absolutely. So the balance between a consumer protection and what the bank could potentially do in that scenario is, I guess, up for debate. But that for me is one of the most convincing and terrifying stories of a social engineering scam, which shows how sophisticated fraudsters are becoming.
Then we'll get later into mitigation techniques, because I guess the dispute systems weren't in place at that point, so the guy clearly lost his money. But Carla, let's turn to you now. Yes.
Sorry, I just wanted to add into a little bit of what Rebecca was talking about. I mean, I've had some consumers contact us, and some of my friends who represent consumers who get a phone call, and the caller ID says it's their bank. So it's like Wells Fargo, it says whoever it is. And then they call them and tell them, did you authorize this transaction? No, I didn't. Okay, log on, give us your PIN. So it's not just, there's so many different ways of social engineering that she was talking about, and the scams and how sophisticated they are, that it's really hard to say, you fell for, it's all you, it's poor you, which is, part of the reason why I think that the Zelle network and EWS has agreed to reimburse certain, me-to-me scams when it's your bank who shows up on your caller ID. Had another woman who contacted us, and she said she got this call from her bank. She hung up the phone. She looked at the number on her actual card and called them, and they rerouted it to these scammers. So she's actually calling a legitimate number to check, hey, is this my bank or not? But they're rerouting it. And so, I think that I know that this is a later question, but the systems have to protect consumers and have to build consumer confidence. And there's a very real difference between getting someone who's using the system to reach out to you on the system versus someone on the street coming up to you and saying, hey, give me money, or hey, buy this product for me. But I also want to say, one of the biggest misconceptions that consumer has, and it's not just consumers, but, by one of the questions here, is that credit cards, debit cards, all of they have two separate laws, and they have two separate liability provisions. And so with credit cards, it is very, you have a lot of strong protections. One of them is the merchant error protection, which you mentioned earlier, right? You purchase a good and service and you don't get that good or service, then you have the ability to dispute it under the Fair Credit Billing Act as an error. There's an investigation, and if you never got that product, you get your money back. The same if it's unauthorized use. That's different than for a debit card or for an electronic funds transfer, which the faster payments fall under, right? The instantaneous payments fall under. They're an EFT. So there you actually have to dispute within a certain time in order to get reimbursed. And so if your debit card is stolen, you have 2 business days to dispute, basically any unauthorized charges, or else you start accruing how much you're liable for. The same with, if it's not a stolen access device, but it's, somebody logs into your account and does an EFT, then you have to dispute it within 60 days. If not, your liability starts to accrue as well. So there's these nuances that a lot of people don't know unless you're a lawyer. So as an unsophisticated consumer, much less are you going to know, the differences in your rights. And again, to everyone's point earlier of these fraudulently induced payments, you think, hey, I thought it was my bank and I am paying, I thought I was protecting myself. They contacted me. So, there's some of that I think is a little hard to definitively point the finger and say you're at fault here.
Well, it kind of reminds me it kind of reminds me of if your house was broken into and they stole some stuff, the police don't show up and say, "Oh, you're on your own. It's too bad." I mean, it's still a crime. You don't
Yeah,
blame the
but
victim.
there's a huge difference, there's a huge difference between, in your police scenario, Deb, there's a huge difference between someone broke into my house and the police showed up versus someone showed up in my driveway. I handed them my toolbox. Then I called the police and said my tools were stolen.
Yeah. And
Yeah,
yeah,
but
I also want to just jump in on just 2 points really quick. For the police one actually got me because a few years ago I did have somebody come into my garage and steal some stuff, and it was my stupidity. I left the door open, but they walked in, they took it. And when the police came, they more or less said tough. Yeah, if it shows up, it shows up, but we don't have high hope. Now, fortunately, like a month later, it showed up some pawn shop and somehow they were able to find it. But, the bottom line was they left me with the same answer. It's like, yeah, dummy, you shouldn't have left your garage door open, which I knew already.
Well, yeah. So thank you, Dean. Blaming your customer and telling the customer they're stupid is a bad way to build a business, right?
Agreed.
At the end of the day, we as an
Agreed.
industry are trying to build a faster payments business. We're trying to build faster payments, make faster payments a thing. And, I was involved with the launch of faster payments in the UK back in 2008 and, jumped to 500 basis points in fraud. And we figured it out. But the bottom line is today, consumers in the UK don't even think about moving money any other way than faster payments. If they want to move money between accounts, they're using faster payments. That's where we want to get in the United States. And in order to get that, we have to make sure that we build confidence. And the way to build confidence is to stop the stories that Rebecca told and that Carla is worried about, right? Now, the bottom line is we can't, in the story Rebecca told, which is heart-wrenching about the pig butchering, every pig butchering scam is heart-wrenching, but an unusual transaction is not a flaggable transaction. And if I do a kitchen remodeling and I pull out $10,000 in cash because my first contractor wants cash, and then I send $20,000 to another contractor, those are unusual transactions, but I'm not being scammed. I want to do that. And so the challenge that companies like Darwinium have is separating the wheat from the chaff. How do I understand when unusual is risky?
right,
Well, and
go ahead.
I was just going to say another challenge that you have layer of that complicates this is you have responsibility. There's different layers, right? You have, the example that you guys all know, right, is you have money that's going from my house, I'm a bank, let's say I'm a bank, my house to my in-laws' house, they're another bank, and I am transferring it by a car, and the car has to drive on a road. So the road are the payment rails. The car could be like the Zells of this world, and then I'm a bank and there's another bank. So you have all these players in this system, and the responsibility of a bank versus the payment rail is going to be different. And if I'm a consumer and I come into my bank and I'm an elderly client and they've known me my whole life, and then I start telling them to make these weird transactions, there is some duty by that bank. And some states have laws that say you owe a duty to that customer. And, especially in the case of like elder financial abuse, that, hey, if these things were flagged and you didn't do anything about it, you may bear some responsibility. And then on the other side, the other bank, my in-laws' house, they have a responsibility. They should have a duty to be screening incoming transactions that look, or am I allowing an account to be here that was by a fraudulent actor? Like, I'm supposed to be complying with KYC and BSA, and this smells iffy, and I'm allowing this new account to accept all of these payments. So like those players are different than the rails, and then the thing that's taking it. But then there's also that you have to make the rails themselves safe, and that's the whole thing with instant payments, right? Is once it's gone, you can't stop it. Like, you don't have a police that can say, hey, stop, I'm going to stop you, car, you ran that red light. You don't have anyone along that who's playing that role. And that's what I think is so scary to people who realize that, you can't claw back that same money. So many people I talk to say like, oh yeah, but then you can just like get that money refunded to you. And I'm like, that's not how it works. Once it's gone, and then they have to agree to initiate a new transaction to send it back, but you can't just claw it back. You can't actually even do that with wires anymore. Like that, you can't stop them.
You never could, yeah.
Okay.
And we have 100%. We have experience, by the way, in the banking system of, irrevocable transaction wires. We've been doing this for 150 years. And to quote Gail Hillebrand, one of my favorite consumer advocates, Gail's a fan of saying irrevocable does not mean irremediable, right? So a transaction, an individual payment transaction that when made in this direction is irrevocable does not mean that if these two parties figure out that something's wrong with it, that you can't then remediate the payment. And in fact, in the UK, they have now legislated a reimbursement model. Why? Because the bad guy doesn't live on the send side of the transaction. We have spent 30 years building fraud and risk management transaction, checking on the send side of a transaction. The bad guy in this case lives on the receive side of the transaction.
If I could get Rebecca back into the discussion here. So we talked about mitigation techniques, notably in the UK, but maybe some of the other ones, Nigeria, Brazil, et cetera. Are there any that you think should be adopted, or any lessons learned or missteps from that global experience?
Yeah, I mean, I think going back to that point about understanding behavior that Peter is making, understanding behavior that is genuinely high risk or genuinely unusual for that user, as opposed to something just different that they haven't done before. So we know from the UK that point solutions, so solutions that look at a moment in time or a snapshot transaction, like when someone is logging on purely on its own, or when someone is making that payment purely on its own, don't work. So the context of being able to understand what a user is doing right across their payment journey, from before they've even logged into their bank account, through every interaction they make, through setting up a new beneficiary, through making a payment to that beneficiary, through kind of repeated payments to that beneficiary, is really key. So a lot of the banks that we've been working with are working through ways to build better visibility of user behavior across every point in the customer journey. So I think that's the first thing. I think there are then two other kind of interesting things from the UK market that we're looking at and trialing. So one is a test of tailored messaging within the context of a live payment journey. So you're probably familiar with a warning when you're trying to make a payment to a new beneficiary that says, hey, stop, are you making a payment to a friend or family? Are you paying for goods and services? In the UK, these warnings have become really familiar to most consumers, really generic. And so, for example, when I'm setting up a new payment, I know that I'm just going to tick the first box because I just want to get the warning out of my experience as quickly as possible so that I can make that payment. That's exactly what someone who's in the middle of a scam is doing. And actually, fraudsters are socially engineering people to say, just tick the friends and family box. It's fine, just tick the friends and family box. And what the Ombudsman in the UK has actually said in kind of reviewing a number of scams cases is there opportunity to live interject in that payment to give the person a much more tailored warning, which says, hey, Carla, it looks like you're about to pay a cryptocurrency. Cryptocurrencies are associated with really high scams instances. Before you make this payment, just give us a call so that we can talk it through with you. No one has really done the research to see whether that would work, but it's an interesting strategy. And actually, finding solution providers who can do that live interjection is a really interesting one. And then the second one goes back to your point, Carla, around putting more of the emphasis on the receiving bank and understanding much more about the age of that account, the legitimacy of that account, whether it's got a trust level associated with it. can also help the sending bank understand whether they want to authorize the payment. And then the final thing, which is kind of really up for debate, is, we've spent a lot of time talking about faster payments. In some cases, the banks in the UK are considering trialing slower payments. So for certain high-risk transactions, they're considering putting a 4-hour hold on that payment and actually using that time to call the customer and say, hey, do you really want to be making this payment? Because it looks to us like it could be fraudulent or it could be a scam. And obviously, I totally agree with you, Peter, that faster payments is a great thing. I love faster payments. I can put money into my kids' account instantly when they're stuck on the other side of town with no money. I don't think anyone's debating that we want to retain that. But in some instances, it might be worth considering slower payments if it does reduce the instance of fraud.
100%. Time accrues value to the fraud fighter. I have spoken with many community financial institutions that launched Zelle. They're getting crushed by fraud, and they just put in a rule and say, if there's a first-time payer, I'm going to hold it for 72 hours. Now, that's 100% against the value proposition of Zelle, but by stopping all first-time payments for 72 hours, they cause the people who are doing it in nefarious situations to stop and think.
Yeah.
Most people, when they, in the moment, oh my gosh, I have to do this. This is important. I've been told about the urgency of completing this transaction. And when you get them to stop and think, it's exactly what we were trying to do with Aunt May when Aunt May was trying to send a wire to the Philippines. Aunt May, stop and think about it. You've never met this person, the picture, blah, blah, all those things. And so time accrues to the benefit of the fraud fighter if you slow it down, and it accrues to the benefit of the fraudster if they speed it up, right? And so one of the things I tell people all the time is instant payments means the rail is instant payment. You get to choose the value proposition you want to deliver in your product.
Yeah.
Rebecca, in the example you gave earlier with the guy who lost 100,000 pounds, was the financial, for those of you who don't know on the call, there's the Financial Ombudsman Service in the UK has a dispute investigation and insurance fund. So was that in place for that guy?
Yeah,
did he get any money back, or what happened?
He did get the money back. So he went through the process of reporting it to his bank. He then took it to the ombudsman, and after a second ruling with the ombudsman, they did rule in his favor, because they said the bank should have flagged the unusual behavior for him. They went back through about 3 years of his payment history and looked at his typical payment transactions. And I think they found that he had never paid more than like £2,000 to one single beneficiary. And so they said that that was unusual enough behavior that it should have been flagged.
So Carla, from a consumer protection, do you think we should in the US have something like that?
Mute.
You're on mute, yeah.
Sorry, I got kicked off. I came back on. My perspective is going to be obviously, I think, very different than Peter's, but it's because I have a cynical perspective, and I'll tell you why. If we did...
Wait a minute. You're not allowed to be more cynical than I am. Go ahead.
If we did, which I think would benefit everybody, the model that Rebecca mentioned of, hey, these look weird. Your bank is going to call you and say, or, a pop-up is going to say, these look weird. Let's talk about this. Then that actually opens up the bank to potential liability of certain consumer laws, because then they knew or should have known about something that's going on. So if they allow certain things to happen, then they have this information. So you need to have, because they don't want that liability, they kind of don't want that knowledge, because ignorance is bliss. You have to make them want that knowledge by putting more pressure on them and saying, hey, you're going to be liable for, if to the point of the UK, right? They have the 50% liability now for unauthorized push payment fraud. And so now they're like, okay, we need to put things in place because we're going to be on the hook for this. We're going to invest some more money into our protections, our fraud protections, and educating our consumers and talking to our consumers. So that would happen if we had it in place here in the US, that there was more responsibility on either the receiving or the sending institution to do more. But if they don't have to do more, and if by doing more, they actually open themselves up to liability where they don't have it now, then they may not do anything. And so then that pushes it off from the institutions to either, the EWS, Zelle, RTPs of the world, or to the Venmo, PayPal, Cash App of the world. Like, it basically, okay, I'm not going to get this from my bank. I mean, and I've heard this from a lot of smaller credit unions. They do not allow that. They don't want to deal with Zelle. They don't want to deal, whether RTP or FedNow that Zelle is using, because of the fraud issue, and it's too expensive for them. So they let their consumers, hey, if you want to do faster payments, go use Venmo, go use PayPal, go use Cash App. But we're not going to, they don't want to have any part in it. So if
maybe they don't realize that anybody can sign up for Zelle, even if their credit union has not joined Zelle, because it's an independent app. But anyway,
and I mean, we love to beat up on Zelle, and I used to work for Early Warning, and I'm not defending them, but fraud in Zelle has historically been far lower than fraud in PayPal or Venmo, right?
I agree. I agree.
And at the end of the day, financial institutions see fraud in PayPal and Venmo by their customers calling the bank and complaining about debit card transactions, right? So, I don't think this is it's not a zero-sum game. First of all, no one's talking about push payment fraud on RTP or FedNow, and the reason is because it's vanishingly impossible for a consumer to actually send an RTP or a FedNow payment. As a result, if I'm a bad guy, that's a very small target area, right? We're hearing all sorts of stuff about Zelle because why? I'm a bad guy. I want my money in real time too, right? So that's a good target. And just like the UK, where eventually reimbursement models came up, Zelle came up with rules that were implemented last June that were specifically targeted, Carla, at those fraud cases where I got a text message that claims to be from my bank, right? And so in cases where though you have this scam where you were scammed by someone that appeared to be your bank and it happened on Zelle, Zelle implemented a rule that there's a reimbursement model. And in that case, the reimbursement model comes 100% from the receiving financial institution. And I think Rebecca brought it up that banks need to really be thinking about the accounts that they have in their own house, because those accounts are potentially the accounts that are going to be money mules. Now, that becomes a little bit of a challenge too, because it would be so easy if the account to which the money was moved was the fraudster's account. That's not how it works, right? There's layers of mules. So it's a challenging situation, and we have to figure out. Like I said, time is great. Recognizing behavior of a consumer that is not typical, slowing them down and saying, "Hey, even if Rebecca made one statement which I smiled at because I 100% agree that." A bank doesn't want to stop somebody and say, call me, because they're accepting some liability then, and they don't want that liability, right? But having a policy that says first-time payees, you got to wait 72 hours, it forces the consumer to think about it. Grandma's going to call their children and say, hey, you know what? The darn bank stopped my payment for 72 hours. What payment, Mom? And they're going to talk about it, and they're going to say, Mom, it's a good thing you didn't make that payment. So just slowing things down will give people an opportunity to think about it, talk to other people, make the decision on themselves. It's not going to work all the time, but right now, we don't have a perfect solution. And by the way, the reimbursement models that don't exist for FedNow and RTP will exist once you can access those payment mechanisms.
There are other things in place that you can do besides the 72-hour hold period. You can limit, which they already are doing, but you limit the amount of transactions, like amount of money you can transact, right? So not $10,000. it has to be a smaller amount, and that also protects, because then if you're doing, the fraudsters won't use that. Actually, that's why wire fraud is up right now, is because they can get a huge chunk of money, $100,000 through wires, that they wouldn't be able to get through Zelle. So even though you're, sorry, I'm just using Zelle because that's the one everyone knows, but through instant payments, because usually it's smaller increments, like $1,000, $500, especially if you're a newer consumer, the amounts that you're allowed to send is smaller than once you've been using it for a while. They can go up. And so to somebody's points here, I think it's Teresa's point here about, are banks going to pay attention to the smaller retail accounts versus like private equity or the business accounts? Probably not, because the amounts are so small on here. It could be $50, $100, $1,000, but it's not going to be the $100,000 that you see if it goes B2B and large transactions.
Right, but I think this whole discussion has highlighted a number of regulatory gaps, because if the banks were liable, they would put monitoring systems in it. As you can see, there's been a lot of activity in the chat, and my friend Jay Rivaz, who you just mentioned, Carla, he had a couple of really good questions. One was, these are horrifying examples. How are consumers supposed to protect themselves? And then she also asked a question which we had on our list of things to talk about, which is about industry collaboration. The Faster Payments Council, what are we doing anything to promote the idea of industry collaboration? And I have my opinion on that, but I'd like to hear Carla and Peter, your thoughts on those two topics.
So on how do consumers protect themselves, that is the exact challenge. Like, consumer education isn't enough, and that's why we think more should be built into the system. I really like the confirmation of payee is one simple step, just like, that. Why not? Why aren't we doing that already? Or like accepted numbers, especially if it's like in the case that you mentioned, Rebecca, sending money to your kid, you put that as a preferential account or an accepted account so that you don't fat thumb it to someone else accidentally. So some of that can be, again, the amount of transaction, or even the pop-ups that we mentioned of like, are you sure you want to send this to this person? Like, this could be a scam. Like, just there's some of those things can be built into the technology to educate, because to the point of scams are always changing. You educate a consumer about a scam, then another one's going to pop up, and then you're going to have to, so consumer education, important, but not the only solution. Shifting the liability, like you have to think about who's going to bear the liability and who can bear it better. The system, the financial institutions, the consumer. I have my opinion, everyone has their opinion. But yeah, regulation is necessary. And, I think that, we've talked about this in our discussion of fraud sharing and information sharing, is that in the US, our not only our regulatory structure, but even our laws are very fragmented. And so you have oversight from all different regulatory agencies. You have OCC, who oversees some banks, and FDIC others, and the FRB, and then some that are only state charter banks and have no supervision. So like the Cash App and PayPal, Google Pay, Apple, like none of those are supervised. There's a proposal right now by the CFPB to be able to regulate and supervise them. But there's so many different parties, and they're all treated differently based on who they are. And so getting them to all work together and force them to work together to share fraud is really, really difficult. And I think absent a mandate to do so, there are reasons why they may not want to. Competitive advantage, there's a lot of, which I'm sure Peter can talk more about, worked for them.
Right. In the couple minutes we have left, I'd like to just do a round robin, have everybody say one piece of advice you'd like our audience to take away from this discussion. Peter.
Addressing the comment that Carla just made, I would say that regulation follows innovation, meaning we're in a period of innovation, and regulating before we figure out how this innovation will work will both stifle innovation and end up with bad regulation, right? So we do need to allow this market to evolve a little bit. That doesn't mean that I'm against regulation. I'm against bad regulation. You talked about information sharing earlier. I'm on the scams information sharing group pulled together by the Boston Fed under the Fed Payments Improvement Initiative right now. And this is now my third information sharing industry effort, right? And I work for Early Warning, which is a consortium. And information sharing is great, but it's really hard. It's difficult. And so figuring out minimal amounts of information that can be shared and doing it in privacy protected ways that are non-competitive would be great. I think there are ways to do that from a technology perspective, but we just need to get people to agree to it. Anyway, so I'll stop there.
Rebecca, your final thoughts.
Yeah, I'll just carry on your point there, Peter, because I've been involved in quite a number of industry collaboration events in the UK around this exact subject of data sharing. And it is a massive challenge, not least because of what you said, Carla. There are privacy concerns with sharing sensitive data and the competitive advantage, but the overwhelming response from the industry and from banks is they understand the value of data sharing and sharing information on fraudulent actors and fraudulent accounts, and they are invested in looking for ways of making that happen. So that is being taken up by industry bodies such as Which in the UK and Stop Scams UK. They are looking for better models to be able to facilitate that, you know, whether it's using privacy enhancing technologies or various different things. I think there is the general consensus that there needs to be some independent body managing that, so that it isn't any one bank's responsibility to share or not share, but that it is actually kind of incentivized or encouraged by an independent body. But I think that is going to be the way to go. And I think, yeah, the other thing for me is just working with banks to try and implement solutions that target the customer experience and doesn't remove anything from the benefits of faster payments, but does give them some level of additional assurance that their bank is understanding what is normal for them and working with them to flag anything that is kind of high risk.
Okay, and Carla, your closing thoughts. You might be on mute. On mute. Yeah.
Sorry, I have phone and computer both muted. So, you know, I think that my closing thought is, and what I spend a lot of my time doing is trying to talk to the CFPB and to Congress and to practitioners and consumers and educating them about the challenges and where there's a role for them to play and how they can help address some of these challenges. And I think that it's not going to be just one player, just one party, or just the industry. I think that all of us have to work together and think through some of these solutions. But there certainly are things that we can do absent regulation. And so I do think that we can do that through technology. I think we can do that through, you know, I think that Early Warnings has taken a good step in the right direction about how they're going to hold the financial institutions accountable for certain types of payment scams. And, you know, and then I think that fraud reporting, that Fed now will require fraud reporting. And I think the clearinghouse is doing that. I think those are great first steps as well. So, yeah.
Great. And I can't believe how fast that went. And with such an awesome group of panelists with the different perspectives and the lively discussion and everybody who interacted on the chat, that's really great. So